Welcome out, guys. Welcome back, actually, to another edition of the Morning Mailbag. One of my old columns I used to do here, video columns that we have here at Tackle Trading. I'm going to revise it and bring it back in here. Revise it, whatever you want to call it. Some kind of retool it, reintroduce it. Let's get right into it. All right, moving averages today is going to be the topic in the conversation. Let's start with this. Question from Stu. It says, "Hi Tim, I just watched Matt's video on indicators and moving averages. He used the 20, the 50, and the 200-day SMAs. I've been using the 10-day SMA and the 21-day EMA for spotting crossovers. What do you think about using shorter time periods for sideways movements, such as which the markets have been in since the start of the year? Regards, Stu." Good question, Stu, and thank you for the question. And let's talk a little bit about MAs. A moving average is a line on a chart. Okay, that's what it is. And if I remove this, you bet. Let's get rid of probability cone. And let's add them in. There are two different types. There's what's called an exponential. Well, two basic types. There are more than this, actually, but two basic. There's what's called an exponential, moving average exponential, and there's what's called a simple moving average. Let's first start by building the simple moving averages, and we're going to put 3 of them on. Give it the old double click and double click and double click. Inside Thinkorswim, you then have to set them the way you want them. A traditional setup, like Matt talked about in that video, would have been a 200 period for a long-term view. Okay, a 50 period. Usually make that red for an intermediate term view, and then a 20 period for a short-term view. So let's apply that and look at it on the chart. Now, one of my very first technical analysis classes that I took was actually the Master Trader back in 2005. Now, that Master Trader has changed a lot over the years, and the current version of what it was written by Noah and myself and Matt and actually Troy Cornelison, a mentor at Legacy Education. And in the Master Trader, the original one I took, they had the 20, the 50, and the 200 period moving average. And the idea went like this. The 20 is your short-term trend, your 50 is your intermediate term trend, and your 200 is your long-term trend. So if you're going to use MAs to identify trend, then the 20, the 50, and the 200, okay? Those would be the MAs that I would use. So the first part of this, Stu, is what are we using the MA for, right? You know, if we're just using it to help us spot the trend and maybe a technical catalyst, I'm going to put that in here, and technical catalyst, then I would stick, with these MAs. And 20 is kind of your short term. 50 is your intermediate term. And your 200 is your long term. Okay? And essentially all you're doing is you're looking at this and saying, okay, well, it's in an uptrend, an uptrend, and an uptrend. All 3 of them are pointing in the right direction, in the same direction, I should say. Whereas if you're looking at, I don't know, let's bring up like Walmart. Walmart's not been a good performer this year. You'll notice falling moving averages, okay? When these things cross over, it can be an indication of a trend change. Now, there's an alternative view of moving averages, though, and this is where Stu's talking. He used the word crossover. Using crossovers as entry point signals. Some people use a crossover system, and what it sounds like what Stu's using is a 10 and a 21 period. I'd have to test that. I can tell you 2 crossover systems that I like. I like the 13 EMA and the 21 EMA, okay? And in general for position traders, okay? Or I like the 4 EMA over the 8 EMA for swing traders. See those two differences right there. So let's go take a look at what a crossover system would do for you as an alternative to using the 20, the 50, and 200. Now you may be thinking, well, Tim, just give me the answer. The core of it, you have to answer a question first. Do you want to use it to identify the trend in the catalyst, or do you want to use it to help you get into a trade so that you know when to trade it? And I like these different systems. Now I'm going to actually let's do this. Save this style, and we'll call it 20, 50, 200 SMA, so I can come back to it. Okay. Now we are going to reset the chart to the default, take all those MAs off, and now we're going to add those EMA systems. EXP, find the moving average exponential, add it in there twice. Let's start with that 13 and that 21, okay? And I'm going to make it, blue is fine. That's fine. This was shown to me by one of my mentors. We'll do blue and what will stand out? Pink, okay? Okay, essentially a trader who uses a 13 and a 21 period is going to be looking for signals that might produce a result that lasts for some time. And when they cross over, that's thought to be a time to go ahead and get in. So where would these signals come in at? Okay, well, you'd want to work in the general direction of the long-term trend. So this crossover to the downside here would push us bearish. You see where it starts to expand in there, lets you know that it's becoming bearish. Here's a good crossover back to the downside here. And actually it's converging here to potentially cross back down at some point as well. Let's just pull up a few random stocks. Look at Exxon, some of the big names maybe. Let's look at ExxonMobil. Okay, good crossover to the upside here. That would have been a buy signal. Crossover back to the downside here. That would be a sell signal. And crossover here, it's when one line crosses the other. Crossover here to the upside, then the downside. Downside here. You can kind of see them. Now that's one way to do it. That's one way to do it. Okay. And the other system, we're going to save this style. We'll call this the 21 13 EMA crossover. Okay. All right, now let's reset it to the default. Now we'll add a few indicators back in there. EXP. We'll add it twice. Okay. This time we're going to do a 4 MA. Let's do some different colors. Orange. You bet. My daughter's favorite color is orange. I know. It's strange, but it is what it is. Okay, so we're going to do orange here. And then we'll make something pop, like not a yellow, but let's do orange and green. Those will be easy to see each other cross. Now this system is much more aggressive, and the crossovers happen a lot quicker and give you those signals. And so for example here, EMA crossover would have been here to the downside. A swing trader would have taken that trade. An EMA crossover would have been here to the upside. A swing trader would have taken that trade. Downside here didn't work real well, but that one would have been a signal. Okay, see how they cross and they give you a lot more signals. So it's more of a tight trading range, and you're looking for quicker signals and quicker hitters. So back to the original question here, Stu, which I really like. He says, I just watched Matt's video on these MAs, and I use a crossover system. Matt was using a trend following system is the answer to the question, Stu. Long way to get to that answer, by the way. I wanted to explain it to you thoroughly so you understood it. So by using shorter time periods or even EMAs to identify crossovers, you're looking for trend changes so that you can actually make trades on it. When you're using the 20, the 50, and the 200, and I'm going to save this style as the 4-8 EMA. Yep. And let's go back and load that other style for the 2050-200 SMA. Maybe we didn't get it right in there. Oh, maybe I didn't include the study sets. But so let's change these then. Yep. Simple. And simple and simple. Let's do the 20, the 50, and the 200. By using these EMAs, what you're simply doing is trying to help you identify the trend. You know, and traders tend to look for key locations, for crossovers, and that kind of thing. My advice is you know, make a decision on, and maybe even use both. Some stocks are really good for crossovers, you know, and maybe you save a chart style with the one, and then you can kind of flip back and forth when you're looking for entry points. The reason the 20, the 50, and the 200 are significant is so many traders out there in the marketplace use them. So it's kind of a confirmation bias type thing. Because everybody else is looking at them, you should probably look at them as well. All right, good question from Stu out there, and this has been another edition of the Morning Mailbag.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.